Listen closely, because what's unfolding right now could fundamentally reshape how wealth flows across borders in ways most investors won't recognize until the damage is already done. Everyone's fixated on surface drama and inflammatory tweets, but beneath all that noise, something far more consequential is taking shape. A critical inflection point has emerged, and it's positioned directly where Greenland negotiations, escalating tariff threats, and a worldwide rush toward tangible assets all converge. Here's what should grab your attention immediately. Financial markets are already moving like they've entered an entirely different era. This isn't some distant future scenario. This is happening in real time, right before your eyes. Before we dive deeper into this analysis, I need to address something important. There's an ongoing battle against channels that steal content and flood platforms with recycled material that buries genuine research. If what you're watching here provides real value to you, then show your support by subscribing and leaving any comment below, even something as simple as mentioning John AG. That single action signals to the platform's algorithm that you're seeking authentic analysis instead of regurgitated content. Beyond that, I've established a WhatsApp channel for those who want immediate updates, quick commentary, and personal insights that don't always make it into full YouTube videos. You'll find premium-style posts, instant voice messages, and rapid updates whenever situations shift between uploads. The link sits in the description below. Join so you stay informed during the critical moments that happen between these longer videos. Now let's get into the substance of what's actually happening, because this situation extends far beyond a simple headline stating Trump wants Greenland. That's merely scratching the surface. The deeper reality involves strategic control, geopolitical leverage, and a complete repricing of risk across every major market on Earth. During the past weekend, the American president intensified his campaign to bring Greenland under United States control and directly connected this objective to substantial tariff threats against multiple European nations if they stand in the way of this arrangement. These tariff threats begin at 10% on the 1st of February and climb progressively toward 25% by June. The moment that declaration hit the wires, markets responded exactly as they always do when genuine instability enters the picture. Equity markets dropped, treasury bonds sold off, the dollar weakened against multiple currencies, and those assets that many dismiss as boring suddenly didn't look boring whatsoever. Gold surged to fresh record territory around $2,863 per ounce, based on the material we're examining. Silver exploded past $94, suddenly feeling dangerously close to that psychological triple-digit threshold. Now, I'm not here to tell you what to buy or what to sell in this video. What I'm telling you is that the market itself is broadcasting a clear signal, and that signal says this: when global power structures begin realigning, capital moves first. So the real question becomes whether this is merely theatrical chaos designed for headlines, or if we're witnessing the opening chapter of an entirely new strategic doctrine. Because when you start connecting the breadcrumbs, you'll notice this wasn't improvised or spontaneous. Several months back, a national security strategy document emerged that outlined a fresh set of priorities. The language essentially transmitted one unmistakable message. The United States intends to secure primacy close to its borders, and it plans to prevent rival powers from acquiring or controlling strategic assets throughout the Western Hemisphere. That's not some minor policy adjustment. That's not bureaucratic fine-tuning. That represents a hard line drawn in the sand. When you layer that statement over recent actions involving Venezuela, a clear pattern begins materializing. Consolidate regional influence, reclaim strategic leverage, and squeeze out competing powers where geography matters most. Here's the angle most observers completely miss. Greenland appears to be nothing more than an ice-covered landmass in a forgotten corner of the globe. But in the world that's rapidly taking shape, where hypersonic missiles traverse polar routes, where new shipping lanes open through Arctic waters, and where sensor networks and interception capabilities become decisive, Greenland transforms into a critical square on the global chessboard. If you're questioning whether all this drama is genuinely worth the attention, stay with me, because the drama itself serves a purpose. The drama functions as part of the pressure campaign. That's precisely why this particular week, with global leaders assembling in Davos, could either de-escalate tensions or detonate into something markets cannot afford to ignore. So let's dissect this the way serious investors must approach it. What drives the strategic logic? What drives the economic logic? And what implications does this carry for gold, silver, the dollar, and the next wave of market volatility? Start with the strategic logic. Greenland occupies a geographic position that proves crucial for early warning systems, missile trajectory tracking, and the entire concept of layered defensive architecture. People have heard discussions about a massive defense initiative. Some dismiss it as branding, others call it delusional fantasy, while some argue it's absolutely necessary. But the fundamental concept remains straightforward. Detect incoming threats earlier, track them with greater precision, and intercept them more reliably. Whether you believe that's achievable or not, the planning process behind such initiatives changes behavior patterns. If you're planning to commit enormous resources towards sensors, radar installations, interceptor systems, and command infrastructure, you don't want a situation where you'll ask permission later. You want control. Genuine operational control. That's where sovereignty questions, territorial rights, and autonomy become hidden leverage instruments. Even without outright territorial ownership, a nation can push for extended control over critical facilities, transportation corridors, and decision-making authority. The second strategic layer involves the Arctic region itself. As polar ice continues retreating and new routes become navigable, the Arctic stops functioning like a frozen barrier and starts operating more like a strategic superhighway. That translates into shipping traffic, submarine operations, surveillance networks, and great power competition. Competition drives spending increases. Spending increases expand deficits. Growing deficits create currency stress, and currency stress represents one of the quiet but powerful forces that drive gold and silver demand higher. Now let's examine the economic logic, because this is where people either get distracted by shiny objects or they position themselves ahead of the crowd. Many observers immediately fixate on rare earth elements and mineral deposits. Let me simplify this for you. Global powers don't merely fight over what lies beneath the ground. They fight over who controls the entire process, from extraction through final product delivery. Mining operations are difficult. Processing and refining are exponentially harder. The reality is that bottlenecks in most resource supply chains aren't about whether minerals exist. Bottlenecks appear in refining capacity, supply chain reliability, and political control over critical choke points. So yes, Greenland possesses substantial resources, but the immediate strategic value isn't about mining operations starting tomorrow and generating instant wealth. The immediate value lies in leverage, future optionality, strategic denial to rival powers, and the capability to establish a long-term dominant position in a region that becomes more valuable with each passing year. That brings us to the genuine market question that matters. Why did gold and silver respond so aggressively to these developments? Because markets don't require absolute certainty to move. Markets require probability shifts. And right now, probability is shifting decisively toward a world characterized by more tariffs, more fragmentation, increased defense expenditures, and declining trust even between traditional allies. That describes a world where the dollar can maintain its dominant reserve status while simultaneously losing purchasing power over time. That's the nuance most people struggle to grasp. They think the dollar either collapses entirely or wins completely. Reality delivers something far messier. You can maintain a dominant currency that still weakens progressively because supply expansion outpaces confidence growth. The tariff timeline carries significant weight. A threat structure that begins at 10% and escalates toward 25% isn't merely a headline, it's a schedule, it's a countdown clock. And countdown clocks inject rocket fuel into volatility because they force decisions. Corporations relocate supply chains. Countries implement retaliatory measures. Investment funds rebalance portfolios. Traders establish hedging positions. Throughout all of that turbulence, precious metals often function like the illuminated emergency exit sign on the wall. They don't guarantee safety, but they reveal where fear is concentrating. Here's a cliffhanger element that carries real implications for your portfolio positioning. What if this situation transcends Greenland entirely? What if Greenland simply represents the visible symbol of a broader hemispheric consolidation strategy? Because once you accept that interpretive framework, numerous other recent moves suddenly make coherent sense. Infrastructure agreements, military base expansions, pressure applied to strategic choke points, port control initiatives, influence campaigns, sanctions regimes, tariff structures, all components of the same strategic chess match. Within that game, an investor's responsibility isn't to pick sides and cheer. An investor's responsibility is to position capital intelligently. So let's discuss Davos. Davos functions as the venue where global elites project stability publicly while quietly preparing contingency plans for instability. It's where leaders deliver speeches about cooperation while privately calculating leverage advantages. If the American president arrives projecting a confrontational stance, expect 3 predictable outcomes. First, public expressions of outrage. Second, private negotiation channels opening. Third, market overreaction in both directions. That third outcome is precisely where opportunity and danger coexist. Markets despise uncertainty, but markets absolutely love clarity. If Davos produces an agreement, a compromise framework, or even preliminary terms, you could witness a relief rally in risk assets and a temporary pause in the metals surge. But if Davos produces a public blow-up, a visible split between allies, or escalating threat rhetoric, the bid under metals can intensify dramatically, and stress across stocks and bonds can amplify. So what specific indicators should command your attention? Watch the dollar closely. A weakening dollar alongside rising gold prices isn't particularly shocking. That's the classic pattern. But if you begin observing the dollar weaken while risk assets simultaneously weaken, that's the fasten your seatbelt environment. That's the signal that global capital is actively searching for shelter. Watch Treasury bonds carefully. If yields climb because treasuries are selling off rather than being bid up, that's not simply about interest rates. That represents a referendum on confidence, fiscal trajectory, and political stability. And watch silver with particular attention. Silver functions as gold's loud, volatile cousin. When silver runs hard, it frequently reflects speculation, scarcity narratives, and a strange mixture of risk-on behavior combined with fear simultaneously. It can produce explosive moves in both directions. Quick creative pause here, because I want to honor a commitment. If you're interested in silver-related success narratives, stories about people who constructed genuine wealth and transformed straightforward decisions into serious financial outcomes, there's a link in the description directing you to another channel worth exploring. Subscribe there as well and consume several of those stories. It's among the most effective methods to maintain motivation while you're constructing your own strategy. Back to the central narrative, because a larger question lurks behind all of this activity. Is the world accelerating toward a multipolar order where governing rules become regional, alliances become conditional, and money becomes increasingly defensive? If the answer is yes, then gold and silver transcend being mere trades. They transform into indicators measuring how rapidly the transition is progressing. Let me provide you with a framework that prevents analytical whiplash. In a stable world environment, stocks trend up, bonds trend up, the dollar remains stable, gold trades sideways. In a stressed world environment, stocks decline, bonds decline, the dollar declines, gold surges. We're currently flirting with that stressed world pattern. When that pattern emerges, it doesn't always become permanent, but it's never meaningless noise. The strategy document referenced in the source material essentially declares that the United States intends to protect its territory, economy, and societal structure from foreign influence. It also emphasizes keeping the Western Hemisphere stable enough to prevent mass migration pressures and to block rival powers from acquiring key strategic assets. Translate that into market language, and it sounds like this. We're prepared to deploy economic and strategic tools to control outcomes within our sphere of influence. That manifests as tariffs. That manifests as military installations. That manifests as pressure on port facilities. That manifests as energy leverage. That manifests as supply chain control. Let's discuss energy briefly because it's not optional in this equation. When you control energy flows, you control inflation expectations. When you control inflation expectations, you control domestic politics. When you control politics, you influence central bank decision-making. And central bank decisions represent one of the most significant hidden drivers of gold prices. This explains why, even if you don't care specifically about Greenland, you absolutely should care about what Greenland represents, a willingness to treat geography as leverage once again. The original material connected this to petrodollar mechanics, oil transactions denominated in dollars, and the leverage that system generates. Here's what matters for your positioning. Even if the global financial system is gradually diversifying away from dollar dominance, the dollar can remain the primary transaction unit far longer than many anticipate. However, the cost of maintaining that privileged role can manifest as higher fiscal deficits, elevated defense spending, and increasingly aggressive policy choices. Those costs typically materialize in the declining purchasing power of fiat currencies. That's why when gold screams higher, it's often less about gold gaining strength and more about paper money losing credibility. We need to confront the elephant standing in the room. Are we moving toward broader military conflict? Some commentators throw around major war timelines as if they're scheduled appointments on a calendar. Reality suggests that conflict unfolds in multiple layers: information warfare, economic warfare, cyber warfare, proxy conflicts, and eventually kinetic military operations. You don't need to predict the final layer to benefit from understanding the earlier stages because those earlier layers already impact markets significantly. Tariffs constitute economic warfare, sanctions constitute economic warfare, technology export restrictions constitute economic warfare. Supply chain decoupling constitutes economic warfare. Investors feel these impacts in portfolio performance long before they dominate headlines. So what does this mean for the average person watching this analysis? It means you should abandon "everything will return to normal" as a foundational strategy. During periods like this, your competitive advantage emerges from being early, not from being loud. I'm going to pose two questions, and I genuinely want authentic answers in the comments because your responses shape what I cover in subsequent videos. Question 1, do you believe the Greenland pressure campaign concludes with a negotiated deal or with a fracture in traditional alliances? Question 2, if gold is running at this pace, do you interpret it as a warning signal or as a long-term repricing of what money fundamentally represents? Share your perspective below. Even if you disagree with my analysis, I want to understand your reasoning. And remember, if you've achieved success, whether you generated returns in metals, equities, business ventures, or any other domain, share one sentence about your success in the comments. Your story elevates the morale of someone who's grinding silently toward their goals. Now let's construct the timeline and maintain the tension because audience retention matters, and this story continues evolving. We have a tariff implementation schedule, we have a global summit approaching, we have markets already pricing elevated risk, we have safe haven assets accelerating, and we have a broader strategic doctrine pointing toward consolidation of regional influence. What transpires next depends entirely on reactions. How will European leadership respond? Will they negotiate? Will they retaliate? Will they publicly oppose while privately compromising? How will markets respond if retaliatory measures disrupt trade flows? And how will central banks respond if inflation expectations shift once again? Because if tariffs increase, consumer prices can rise. If prices rise, central banks hesitate on rate cuts. If central banks hesitate, economic growth slows. If growth slows, political pressure intensifies. It becomes a cascading chain reaction. Let's address the narrative warfare dimension because this is where most people get manipulated. Mainstream conversation will reduce this entire situation to one leader causing chaos. That narrative is simple. It generates clicks, but it conceals the structural problem. The system has operated under enormous stress for years, and now that stress is becoming visible to everyone. Debt levels, supply chain fragility, demographic pressures, technology rivalry, energy transition costs, regional security competition. Those forces were already pushing the world toward fragmentation. The Greenland story simply represents a loud signal flare illuminating the night sky. When flares launch, markets search for exits. I want to decelerate and reveal the trap that countless people stumble into during moments like this. They hear about tariffs and classify it as merely politics, but tariffs function as taxes. Taxes modify behavior patterns. They don't just alter prices, they determine winners and losers. When a tariff lands, corporations face three options: absorb the cost and accept reduced profit margins, pass the cost to customers and accept higher inflation, or reroute supply chains and accept operational disruption. None of those choices comes without consequences. This explains why bond markets grow nervous, because inflation pressure combined with disruption combined with higher defense spending creates a cocktail that makes fiscal mathematics considerably uglier. Here's the part nobody wants to articulate publicly. Many modern markets were priced for a world where politics remained in the background. Cheap money, stable trade relationships, predictable alliances, seamless global supply chains. But when politics moves to center stage, the discount rate changes. When the discount rate changes, asset valuations can compress rapidly. That's why you witness the swift market move. Stocks down, bonds down, dollar down, metals up. It's the market's method of shouting, "We don't understand the rules anymore." When rules feel unclear, the most valuable asset becomes optionality, the ability to adapt quickly. Let me make this even more practical because I don't want this video feeling purely theoretical. Imagine you operate a manufacturing business in Europe exporting products to the United States. You've structured contracts priced with thin profit margins. You have inventory currently in transit. You have customers expecting delivery on schedule. A 10% tariff already inflicts pain. A 25% tariff can fundamentally alter your business model. So what actions do you take? You hedge currency risk exposure. You hedge commodity input costs. You renegotiate existing contracts. You lobby your government for relief. You threaten counter-retaliation. You delay capital investment decisions. And those individual actions ripple across financial markets. That's precisely why geopolitics isn't separate from finance. It's the upstream river that feeds the downstream lake. Let's bring gold and silver back into sharp focus with one essential concept. Metals move not solely on fear, but critically on policy responses to fear. When the system experiences stress, policymakers respond. If policymakers respond with spending programs, currency supply expands. If currency supply expands, metals frequently reprice higher. So even individuals who don't care about missiles or territorial maps should care deeply about the policy feedback loop. I'm going to offer you a brief behind-the-curtain moment consistent with this channel's spirit. When mainstream narratives amplify loudly, ask yourself who benefits from that particular narrative. If the narrative projects everything is fine, it benefits the system requiring stability. If the narrative screams everything is catastrophic, it benefits traders wanting you to panic. If the narrative insists don't look at metals, it benefits institutions wanting you trapped in fiat risk exposure. Here's why I'm emphasizing this. When gold and silver are establishing record prices, you'll encounter two categories of headlines. One category will declare it's a bubble about to crash spectacularly. The other category will proclaim it's unstoppable and you must buy immediately. Both extremes are engineered to steal your discipline. The intelligent approach involves watching structural developments, not noise. I want to discuss this story's structure because the Greenland narrative contains multiple possible endings, and each ending carries different market consequences. Ending scenario A. A public fight followed by private compromise. This represents the most common outcome in high-stakes negotiations. If that materializes, expect choppy volatility, but not full-blown panic. Ending scenario B, escalation and retaliation. This is where tariffs expand in scope, counter-tariffs emerge, and the world slides into a trade war chapter. If that unfolds, inflation pressure rises, growth expectations decline, and hedges like metals maintain support. Ending scenario C, an outright fracture. This is where alliances don't merely strain, but fundamentally reset. If that occurs, markets begin pricing an entirely new world order, and that repricing process can turn violent. If you're wondering why I keep suggesting this extends beyond Greenland, it's because I want you connecting dots across the board. A hemispheric consolidation concept doesn't terminate at one Arctic island. It represents a strategic mindset. Control the near abroad, control strategic corridors, secure critical inputs, reduce dependency vulnerabilities. Within that mindset, you could witness moves involving ports, canals, mineral resources, energy routes, and technology choke points. This is why I persistently emphasize don't anchor on the headline, anchor on the underlying doctrine. Let's address a quick viewer question segment because I receive these daily, and they deserve genuine responses. One viewer asked, if gold and silver are running hard, should I wait for a pullback? Or is this the beginning of a new major leg? Here's my framework. If your approach involves short-term trading, you respect pullbacks because sharp moves can retrace violently. If your plan involves hedging long-term currency risk, you don't obsess over the perfect entry point. You construct a position with defined rules. The worst position to occupy is having no plan whatsoever, because then every price candle controls your emotional state. Another viewer asked, if silver approaches triple digits, does that mean it's too late to participate? Not necessarily, but it does signal the market has become excited. When a market reaches excitement, you manage risk more tightly. It's also why I mentioned earlier that silver can produce explosive moves, but can also deliver chaotic volatility. I'm adding one more question that I want you answering in the comments because it matters for retention and for shaping future videos. Do you personally believe the next major shock originates from tariffs or from bond market disruption? Because if bonds crack under pressure, that's when the entire system feels the impact. Let's discuss bonds in straightforward language. Bonds represent promises. A treasury bond constitutes a promise backed by a government's capacity to tax and create currency. If investors begin demanding higher yields, they're demanding greater compensation for perceived risk. Sometimes that risk reflects inflation concerns. Sometimes it reflects deficit trajectory. Sometimes it reflects political instability. Sometimes it encompasses all three simultaneously. If yields rise too rapidly, it creates a pressure point for the entire economy. Mortgage costs increase, business loan costs increase, governments face higher interest expense, growth decelerates. When growth decelerates, politicians demand stimulus. And stimulus programs tend to prove metal-friendly. This explains why I monitor the bond market even more closely than equity markets during moments like this. Let's introduce another dimension, central banks. Even if you never read a central bank policy report, you should understand their incentive structure. Central banks desire stability, but they also desire control. In a world where geopolitical trust declines, central banks frequently diversify reserve holdings. That doesn't mean they despise the dollar. It means they want optionality. And that optionality-seeking behavior represents one reason gold demand has remained so persistent in recent years. I'm not verifying specific numbers from the original material, but the behavioral pattern is what matters. When uncertainty escalates, institutions purchase insurance. Gold functions as insurance. Here's a subtle signal I want you monitoring that most observers ignore completely. Watch how quickly conversation shifts from discussing economic growth to discussing national security. When conversation shifts, budget allocations shift. When budgets shift, deficits shift. When deficits shift, currency supply shifts. When currency supply shifts, metals respond accordingly. Let's discuss the psychology surrounding Davos itself, Many people perceive Davos as merely speeches and panel discussions, but Davos also functions as a networking event where private commitments get made and alliances face testing. Sometimes the genuine news resides in what doesn't get stated publicly. If you observe vague statements like, "we're working on solutions," that can indicate negotiations are intense. If you witness blunt statements and open threats, that can signal the split is real. Markets will trade both scenarios. I'm closing this section with one additional reminder that strengthens this community. If you're new here, subscribe now. If you're a regular viewer, comment John AG. If you want premium depth, check the members-only update that's already available. If you want instant updates, join the WhatsApp channel. And if you've experienced success, share it below. Final stretch now, and we're landing this with absolute clarity. So, what does the Greenland pressure campaign genuinely mean for gold and silver? It means markets are assigning a substantially higher premium to uncertainty. It means trade friction has returned to the table in unmistakable fashion. It means defense spending narratives are intensifying rapidly. It means alliances face genuine testing. And it means currency confidence isn't flowing as smoothly as previously. All those factors prove supportive for metals. But remember, supportive doesn't guarantee straight-line movement. Metals can pull back sharply even within a bull trend structure. What does this mean for the dollar? It means the dollar may retain dominance but faces greater contestation. It means policy choices expanding deficits can weigh on the currency. It means volatility can generate short-term dollar strength at times, but the longer trajectory can still point lower. What does this mean for investors specifically? It means you require a plan capable of surviving volatility storms. It means you should prioritize risk management over predictions. It means you should monitor the bond market like a hawk watches prey. And it means you should exercise caution with leverage in chaotic environments. The final cliffhanger element: what if Davos doesn't produce unity, but instead reveals a permanent split in how Western powers envision their future? If that materializes, markets won't merely be reacting, they'll be repricing everything. And repricing phases are when substantial capital relocates. Here's what I want from you immediately. If you want a part 2 released immediately following Davos outcomes becoming clear, comment John AG and specify which angle you want explored next. Tariffs, metals, the dollar, or the broader geopolitical landscape. Hit subscribe so you don't miss the next upload. Join the WhatsApp channel for instant updates between videos. And check the members-only video that's already live if you want the complete compiled update with deeper analysis layers. Take care of yourselves, and I'll see you in the next one.